All right, guys, today's another AMA with FuturesTrader71, asking any questions about volume profile, about trading in general, option theory, psychology, you name it, we'll go through it. So go ahead and start typing your questions, and we'll do our best today, even though my audio quality is not good. All right, FT, you should have...
Yeah, I'm here.
Okay.
Very cool. Hello, everyone. Let's see. ES screen just to have something up. First of all, risk disclaimer, trading futures options on futures and spot FX involves substantial risk of loss and is not suitable for all investors. Past performance is not indicative of future results. That last statement basically means that you are responsible for testing whatever we're discussing to make sure that it's something that will work for you before taking what I say at face value. So I have to read that out because I'm a registered broker with stage 5 trading, and it's just part of the process. Let's have a look at the questions here.
Sure. Okay, first one is from Rex, and he says, if you're looking to fade an area, for example, a CLVN, do you take the trade on the first push into the area as soon as you see absorption, or after first absorption, are you sitting on your hands and waiting for it to move away a little bit and then come back and retest the area?
Okay, so that's a tough one to answer because it just depends on how it got there. Okay, so let's describe what a CLVN is. A CLVN is this is the composite here, this chart that's on the right. That chart is basically showing what has traded at each price going back as far as this chart's starting date. So the low swing that I'm using right now is the 9th of October 2013. And you can see here it's telling me what has traded at each price for that entire period. So as I go lower, the composite simply reflects all the trading that has occurred since that swing low. So that's what a composite is. A composite CLVN is essentially a low volume node on the composite. So a very clear CLVN zone is, for example, 1800, the 1800 area. See how there's no volume there. Secondary is the 1787.50, and so on and so forth. And what Rex is asking is, okay, let's say we're trading against a composite CLVN like this one at 71. Do I just, step in front of the market and put an order out there, or do I wait for it to fail, or is it a pullback? And unfortunately, the answer to this question is it depends. Simply because I'm trading an auction, I'm looking at not only, hey, here's a line on my chart, I should trade against it, like yesterday's high at 68. Let me just put a bid out at 68. No, I don't trade that way. What I need to see is, first of all, where did the market come from? What does the 68 represent, for example? What does the CLVN represent? Is it in the middle of a noisy balance zone, which it is? In this case, this CLVN at 68, which is yesterday's high, that's where it tested. It tested this CLVN. If it's in the middle of a balance zone, and here's a balance zone, see how the market's just chopping back and forth, then I'm looking at, okay, this is balanced. How far has it extended? What is the day range like? So far, we've traded 8 points on the day session. Do we still have some range left normally? Do I have backup for that CLVN? Is there something backing it up that allows me to step in? Because my goal, as I say in every morning's Trader Bite, or as far as I can remember, if I can remember it, is my goal is to take a trade that has a higher probability of succeeding than failing. But I'm also looking for a trade in a spot where the market has to kind of struggle to get to my stop. I don't mind getting stopped. I don't mind losing. I lose all the time. It's just part of the process. But I want the market to work hard to do so. And so I cannot identify a spot by just putting an order out there. So what I like to do is see how it reacts. See how it reacts. And then if you look at this short-term chart, for example, this is my trigger chart. It's a 2-tick Renko candlestick chart. I'm looking for, let's say the area I'm looking to trade against is 68. I'm looking to see how does it behave as it comes into 68. Is there, if I see absorption, in other words, if I see that somebody's starting to lift the offer or reload the bid over and over and over, then I'm more likely to join the bid or lift the offer to get long. If it's kind of lackluster where there are 500 on the bid, 500 to buy, and it just trades and trades and trades, and it goes through, trades a few times, and it comes back, and the bid comes back, and there's a struggle, and it finally pushes through 68, then I'm still interested in that level because that's an area that I've predetermined that I want to take a trade at. But now I'm looking at 67.50, 67.25, and yesterday's IB is backup. So if I cannot see support or absorption at that point, I'm letting this trade go. It's pushed too far, and now even if I got long, as it pulls back up, it's not giving me enough space to actually get a scale and make some profits. However, as it pushes lower, it's going into yesterday's trading, and so I get a little more support. So I'm okay letting this one go a little bit farther, but I'm never stepping in front of the market, and I think that's what you're asking. I wait for it to tell me that, yes, there is some participation there. There is somebody willing to support it. And my homework's just identifying possible areas of support and resistance, but I wait to see, and I don't mind at all missing, a 12-point trade or whatever just because I didn't step in front of the market. I'm more interested in protecting my capital.
All right. Option Profit says, what is your thought process when looking at a 3 to 4 day mid-range balance area like 8 to 11 points on moderate volume in that range while balancing into a deep low volume node on the right edge composite profile, other factors notwithstanding, for example, news or approaching a holiday, and etc.?
Wow.
Yeah.
That's a pretty detailed one. So you're talking about a 3 to 4 day mid-range balance area. So you're talking about a kind of a micro composite area. So so you're talking about a trade into the mid of a 3 or 4 day balance area. These are 3 to 4 days. Mid-range balance area on moderate volume in that range while balancing in a deep LVN on the right edge. It's very hard for me to answer that, but I guess I'm not understanding the question very well. I'm guessing that you're saying, what if the market is, for example, what if the market drops and starts trading within the last few days of range? What I do is I start to use those prior days as template days, or to identify areas of value, support, resistance, and so forth. Like the most obvious one yesterday was 65, 64, 50. The day before, 50, 59, which was the high, the 59.50, which is the high of February 28th on the old contract, adjusted for the new contract, and then 56.50, and then 51 would be the next area. And the better way to see it is to actually just draw a composite around those days. See, and then I'll be able to identify where those LVNs are. There's one there, like I said, 15.1, and then the overall balance for this zone is still 64.50. I doubt this market will get through 64.50 by far today, but we'll see. So my thought process is always the same. If I'm looking long to support this morning's, the fact that it gapped up and it's pushing back through, then I'm still looking for an area where I can get in, and then I'm really concerned about where my backup is. I want to know that, where's my stop? How far does this need to push for me to be absolutely wrong on this trade? I don't know if I can answer it more concisely than that.
Okay. Rex is asking if we have a P-shaped profile, P as in Paul, is the point where the belly meets the stem a likely long area, and vice versa for B as in boy shaped profiles?
Okay, so a P-shaped profile is this. So if I switch these to left aligned, so this profile here is making a P shape. So here it is. It gets fat at the top and it's thin at the bottom, like that. That's a P-shaped profile. P-shaped profiles show, depending on how they're formed, if the P is formed later in the day, P-shaped profiles show short covering. In other words, the market just opens and it just squeezes to a point where now it's confronted with sellers, and all along sellers are covering their shorts up to the point where they perceive value again, which happens to be the 6450 area, a very important area for this zone. A B-shaped profile is the opposite. It shows long liquidation. We haven't had many of those lately. But the question was, is the point where the belly meets the stem along a likely long area. I don't go, that's more of a Daltonism or Stadelmeier thing where you're just trading off of the shape of the profile. I don't do that. So I'm not really qualified to answer that question. I don't see the fact that the profile is a P shape like this as, hey, this is an indication that we should get long. The fact that it made a P shape right against this point of control, this 6450, tells me the market's likely to go into balance, and it did. The next day, 65. The day after that, 6450. It's testing, but it's ending up, it's really balancing around that point of control. The market likes this price, so this is a fair price. So I don't have anything here that says, hey, get long. You know, this thing based on its shape, get long. So I don't trade off of shapes. I don't think anybody, to be honest with you, I don't think anybody who trades really trades off of profile shapes alone. I don't think that's a viable plan because shapes don't describe how it happened and what forces caused it to happen, what is likely to happen next. Okay?
All right, Jeff asking if you could please explain and possibly debunk Fibonacci's and Fib extensions and talk about how they are self-fulfilling rather than a true measure of reading the auction. And I've read that question exactly, so don't get mad at me, guys.
Okay. I'm not going to debunk anything when it comes to trading because that makes the assumption that I know better than what other people are doing, and I don't. What I do know as a professional trader who's been doing this a while and pretty intensely is what works for me. So I know a couple of guys downstairs. I'm in the board of trade. I know a couple of guys downstairs who trade wheat based on moon cycles. I would not debunk that because they've been doing it for 40 some odd years probably. So I don't know if I'm all-knowing and all-seeing enough in trading to say, bah, that doesn't work. What I do discourage, though, is, especially if you're inconsistent or you're learning, is to just throw so much stuff on your screen, so many lines, and forget that you're not trading a bunch of lines, you're trading an auction. No matter what you're trading, if it's a stock or options or Forex or whatever, you're trading an auction. So if I throw a fib on here, it gives me a bunch of lines mathematically, which I've used. I've used fibs quite heavily in the past before I started to push into the market profiling and then later develop this approach to volume profiling. I used to look at fibs, and the problem with looking at fibs and extensions and, frankly, moving averages and RSIs and CCIs and MACDs and whatnot, stochastics and so forth, is that because it's giving you a certain number, a visual picture of what's happening, and it's giving you a number and a line, it becomes, you relinquish your ability, what I've noticed in my experience, people who I've backed and trained for prop, or people that I've talked to who are online traders, they kind of relinquish their ability, their cognitive and very, very powerful ability to really read what is happening. They start to rely just on that line, and it disregards context. So I cannot debunk fibs. Most everything in the market is self-fulfilling, to be honest. And I've done this in the past. I've talked about in one of the chats I did early on when I came on Twitter. I said, you know what, take the opening price. Today's opening price was 71.25, and throw a line up. Have your charting software draw a line at every point up and down, and I bet you on a small time frame chart I can explain how those lines work magically. Every point. Oh, see where it bounced off here, see where it bounced off there, and it's a mathematical line. But what you're forgetting is that the price and the volume is describing participant behavior. It's describing future perception of what value is. Hey, this thing is cheap, I'm going to buy it. Hey, this thing is too expensive, I'm going to sell it, given the information that I have now. So that's where I would focus. Before you get lost in all of the indicators and mathematics, and with prices, it's so easy to get caught up in the mathematics. Don't hang your hat on one or two things mathematically. Understand what the auction is saying. You know, market gapped up, it tested higher, it is unable to retain higher prices. The high of the year is 77.75. It stops at 77.25. If you pull back on this chart, you'll see that it falls very quickly with very little volume traded at the highs. As soon as it gets up into the 75 or better area, it just falls very quickly. So the expectation is for it to roll over, and that's what I put in our Stage 5 chat room. I said, this thing, I'm waiting for this thing to roll over. I don't think it's going to hold these prices or take out the high. It left a gap behind, but the auction up was, you know, it tried very hard, but it's very poor. Delta dropping, going negative, and so on and so forth. It helps you understand what it came from and where it might be heading, and that's where I would focus my attention. Just understand what it's doing, and then if you need to describe it better or mathematically with fibs, fib extensions, measured moves, fans, whatever you want. Heck, a dartboard in your office, fine, but at least you understand the auction. I think if you base your bias and your context read on where has it come from, what is it trying to do, how good of a job, and what is it likely to do next from here, just from a simple logical point of view, I think you've gone a long way towards developing your approach to the market. And then as far as how you get in, where you get in, you know, if you're using an 8-tick chart with 2 moving average crossovers or whatever to take the sell signal when it shows up because your bias is short, I think your opportunities are better and your risk is better going that way, as opposed to starting with moving averages, fibs, extensions, and so forth, and then try to understand when they work and when they don't. Every trade has a 50-50 outcome. So like I said, I'm not going to debunk any of these. I think all of, you know, in trading, everything works and everything doesn't work. It's a function of how you use it. It's a lot like walking into a tool shop and saying, you know, I think we should debunk the use of hammers. I think hammers are terrible. Well, it depends. If I'm driving a nail, then a hammer's the right tool. That's how I would look at it.
Okay. Thanks, FT. You know, I tried to show something similar. There's a thread on BMT from a few years ago called random line theory, and I used a random number generator the prior night and generated a whole bunch of lines that I threw on my chart for the next day, and you know, tried to make the same or similar argument that you were making about the opening price, how you can make it look like it has predictive powers, these random lines. So it's all in how you interpret it on your chart, right?
Exactly, and that's what context and bias is all about. What is your interpretation? and the market will eventually prove you right or wrong, and it doesn't make you a genius. It doesn't make you an idiot. It just makes you wrong at that specific price with that specific stop. And this is a game of playing a huge number of hands, and then hopefully your edge shows up over those large number of hands or a large number of trades.
Right. Okay, Rex asking, what time period do you define as lunchtime, and how does that affect your trading? What happens if we get into an area to do business and it's lunchtime?
Okay, that's a great question, Rex. So I did a range study, a 15-minute range study over a large period of time, and I ended up with what looked like a heat map for various products. The latest one was the 6E, for example, just to see where the session has the most range, which is where we make our money as day traders, is range. We want price changes. That's the essence of how we make money. And so the market actually goes into a very tight range in general, assuming there's no FOMC or whatever, in general at about 11:15 Central, which is 12:15 Eastern, and it continues to do so till about 2:15 Central, which is 3:15 Eastern. During that time, any hourly volume chart would show you that there's just no volume there. There's no participation, and because there is no participation, the opportunities that you have are limited. Okay, where's the histogram? Huh. Anyway, the opportunities you have are much more limited. And if you take a day session only chart and break it down into like half-hour bars and throw a histogram on there, you'll see that the most volume occurs in the morning. Then it dips strongly from about 12 noon Eastern or so till about 3, and then it picks up again, and it rarely picks up as much as it does in the morning. And at those times, you have to be more cautious. We used to call it whenever, in my shop, we used to say, oh, the interns are in, trading, and it just tends to be choppy. It's day-to-day, local-to-local trading. If I went down to the 4th floor and stood at the pit, you would see the pit is quite empty, and it's just a bunch of locals kind of trading with each other. It's rare that a higher time frame is operating at that time, although it happens. What do I do during that time? What happens if there's an area? I still take the trade, but you have to understand that if you're taking a trade during that lunch hour, you're going to have to be incredibly patient. It's going to sit there, and it's going to fill you, then it's going to go through by 4 ticks, and it's going to come back to scratch, and you're going to want to scratch it, then it goes for you for 4 ticks, and it goes through you again by 2 ticks of heat, and back and forth and back and forth. And essentially what it's doing is it's doing what it normally does. If you fast forward, if you play back that time when you took the trade and ran at 4 times speed or something, you would notice that it's just a trade. It looks like a very normal trade. It's just happening in very, very slow motion. And most people end up chopping themselves to pieces. It goes through them, it comes back to scratch, they watch it go a little bit, they chase it, get in, and then it rotates through them, they take a hit, they get back in, and what ends up happening is you end up taking a whole bunch of trades, one after the other, so it's almost like you lose your mind, and you end up chopping yourself and flipping long and short and long and short. And it's just best, if you look at your statistics for your trades, if you keep those statistics, you will see that those periods over a large number of trades during those periods, that your return per trade is, I'm willing to bet that it's not as good as at other times if you had waited till 10 o'clock Eastern or whatever and traded from 10 to 12 or so. I still take the trades if I'm here, but I understand that I have to cut my size and I have to use a wider stop because it's local-to-local trading. Local-to-local trading means day traders, which means a lot of chop. Okay?
All right. Terry is asking, well, first he says that your trader bite videos are very good, and he says you've mentioned trapping buyers and sellers due to a VPOC shift. Could you explain that in more detail and explain the principles of that?
Okay, so that's a little bit, it's kind of a lengthy topic, and it's probably too long for an AMA. We're actually running out of time, but the way the point of control moves, and you can see it on this chart, this is the pink line is where the point of control has been all day. The point of control is the most traded price. So here on this bar at 1027 Central, it moved from 75.50 down to 72. What you need to know about the point of control is for it to form, for a lot of volume to form there, both sides have to be more active. And if the market's trending down and then it slows down and it slows down enough and trades enough for the point of control to shift down, therefore value, which is the shaded area you see here, that's value. You can see it's gray on this chart here. For value to come down with the market, there has to be a lot of buyers. There have to be a lot of buyers becoming more active or more willing to participate at that price. And so generally what that does is it traps, see the point of control moved over here when we were here, tested the mid, which is something I look for as a setup, and then it broke the IB low, and it comes right back to the point of control where sellers are now again active, and so are buyers. So the point of control remains here and it continues to build here. The point of control shifting means that there's a lot of activity, which means that there's a good chance that one side or another, either the buyers who stepped in, a lot of them who stepped in, or the sellers who stepped in at that price are going to be wrong because they're active. So they're going to have to be stopped out at some point. And if the market pushes lower and comes back to that point of control, chances are in this context the market's likely to go higher and trade this value area for the afternoon until the close. So depending on how it came there, just like with everything else, depending on how it arrived at that point of control, how that point of control moved, it tells you different things, okay? So this is not as simple as A plus B equals C. It's not something you can turn into an algorithm. It's an understanding of what the story is and how the story is likely to unfold from here, okay?
Crude Awakening asks, how can you identify trend days early enough to act accordingly?
So where it opens is a big clue. How it left the overnight session is a big clue. So I look for things like, in the overnight session, I look for a very sharp profile, which tells me that there's a lot of coiling, there's a lot of compression going on. A weak high on the overnight session is another one. So here, before we broke higher right before the open, we had a weak high. 1870 tested, pulled back to 68, 1870 tested. High probability this will break on the open and it'll push through. Today it happened to open out of range above yesterday's range, which means that overnight the participants priced in a gap. And so if the market opens above range and it just opens and just takes off, it just runs up, which it didn't do today. Today it traded both sides actually. It opened and it just chopped back and forth. This is an open auction. This means that day traders are in control, are likely to be in control, and there isn't a longer, bigger institutional, like there isn't a huge participant in the auction, and so it's likely to chop around and it's likely to reverse at some point in the day. If we open out of range, in other words, we have a gap and then the market opens and it immediately starts shooting straight up with delta, in other words, lifting the offer strong, with delta pushing higher and away from the most recent value, then you have a long time frame participant and you have an open drive, and that's when you see on Twitter or whatever, I'll say, caution, trend day, don't fade. Those are the days where you don't want to get short if it does that. If it opens up here, the expectation is it would chop and it would roll over and it would go and test the most recent value, which is down here from yesterday. You would expect it to come back to 65. And if it doesn't do that early on, then it's likely to break higher. And so that's how I measure whether or not a trend day is coming. Is it's where is it opening and what kind of activity did we get on the open? Because on trend days, it is a much, much larger participant. Somebody who has to fill 50,000, 100,000 contracts on the open or near the open that comes in and then just starts to work an algo that's just buying every pullback, buying, 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 bang. We want to identify that early on so we know, okay, lay off, don't take any shorts today. They have a low probability. But if it opens, you know, chops up and down before it breaks, it's an open auction. It just means that there isn't really that heavy participant, and it's safer to play both sides of the market that day. So opening types are very important, and I always post them in the morning. Opening types and the opening swing are very important to measure that action, okay?
All right, so let's make that the last question since we're up on 30 minutes. I want to thank FT for his time as always. Thank you guys for putting up with my poor microphone setup today. I'll post a recording of the AMA on YouTube a little bit later today. If you have questions for FT, there's about 20 questions it looks like that we did not get answered today. There's a AMA thread on BMT. You can post all those questions there. He'll do his best to answer them. You can also check out his website, FuturesTrader71.com, and his brokerage, Stage 5. What's the URL for that?
Oh, brokerage is Stage 5. It's stage5trading.com. You can find us there. You can contact me through there. If you have technical questions, trading related questions, it's FuturesTrader71.com, like you said. But Stage 5 is the brokerage, and the broker will respond in that case.
All right. So thanks, guys. Thanks, FT, and I'll see you next time.
Thanks for having me on.
Sure. Bye.